Real estate is not about investments.
Every piece of real estate would have gone easily 3 to 4 times. Bangalore, Hyderabad, Pune.
You cannot operate in this world without real estate.
I am not biased towards real estate. I am against how much CAGR it is making. Leave aside the emotion attached to the real estate.
We are not emotional about our real estate assets. I have upgraded into a third house. I'll upgrade into a fourth house also.
Day after tomorrow, I need money. You cannot sell your house within 3 days and get the emergency fund.
I completely disagree with you.
In Bangalore, for a 60 crore house, somebody has offered him 3 lakhs rent. The rental yield is very small.
Last 3-4 years, equity has given zero return. Even SIPs have given negative return. And mark my words, I've been in real estate for the last 15 years.
So in a country like India, I guess if you do not own a piece of real estate, there is zero social security that you have. It's a fool's investment.
I have a little bit of difference of opinion here because
What is your current net worth and percentage allocation? How have you broken it down? I would say 50% of my wealth is in real estate. 50% of my wealth is in other liquid assets. Within liquid assets, I have exposure to crypto. I have exposure to direct equity. I have exposure to balanced mutual funds. I have exposure to equity mutual funds. Within equity mutual funds, I have exposure to sectoral equity funds, large caps, flexi caps, and that's how my portfolio kind of looks like today. I am a very long-term investor. I don't believe in SIPs and I don't believe in profit booking. Whatever I have invested in mutual fund, I don't even remember if I would have ever redeemed it because I plan it in a manner that when I get regular income, there is certain regular income which is kept aside and the other income would get invested over a period of time. I have a direct equity portfolio also. Within equity, my direct equity and mutual fund, 60% would be mutual fund and 40% would be direct equity. In direct equity, I do not invest in more than 10 stocks. I keep it very concentrated. And as I said, in the overall portfolio, 50% is real estate, 50% is equity. I am a debt averse person. I don't know why. So if I have a real estate portfolio of 1 CR, the debt on that would not be more than 10 lakhs. So my EMIs are very less. I am now on an entrepreneurial journey. I am not on salary. So it was very important for me to kind of free my real estate assets so that where my family is staying, there is no risk whatsoever. And that's how I kind of look at it. And I'm happy with the return of 7 to 8% coming to me on an annualized basis.
For me personally, my network of around 850 odd clients, they are my net worth. I'll be honest, I bought my first asset pretty late because, I might look pretty old, but these gray hair, I'm just 40. So in 2010, I bought my first real estate asset. And since 2010, I've seen it grow almost 4.5 times. I sincerely believe what I do. I love what I do. And that's one of the main reasons 75% of my investment portfolio is only real estate. And I'll be honest, the remaining 25%, why it is not real estate, because I want it to be liquid as well. Real estate, to be honest, is not the most liquid asset in nature. But the other assets that I've invested and parked my 25% of my investments is gold and equity as well, which is pure stock market. If I had my way, I would have parked 100% of my assets in real estate.
My current net worth is confidential, but my asset allocation is not. About 15% of my total corpus is invested in government-backed fixed income securities. The rest 80% is invested in equity mutual fund, direct equities, and also in my son's business, and a little bit in gold and silver, a small allocation of 5% in gold and silver. And my only allocation in real estate is my own residential house, which I don't take into account into my net worth because I don't intend to sell it. So it has got zero value as far as myself is concerned. And it doesn't generate any income. So that's not considered as a part of my net worth at all.
What is your personal philosophy when it comes to investment? What are the benefits of real estate as a good investment? So, in a country like India, I guess if you do not own a piece of real estate, there is zero social security that you have. The stock markets, the equity markets, they're very, very volatile. We've all seen what has happened in the last 3 or 4 years. I guess people have hardly made any returns on any of their equity markets, any of their stock market investments in the last couple of years. Vis-a-vis, when we talk about real estate and when we look at a 5 year growth period, I would talk about my experience of the last 2 decades, right from 2005 till 2025. I think every real estate piece of real estate in every major market. And when I say major market, I talk about cities like Bangalore, Hyderabad, Pune, Bombay, Delhi NCR, right? Every piece of real estate would have gone easily 3 to 4 times. I mean, without me doing any active effort and checking my stock portfolio, rotating it, right, diluting it, reinvesting it, it's a fool's investment without any brain. The only thing that you have to do is make sure that it's legal and the title is clear. As long as the title is clear, as long as the property is legally acquired, any asset in these A grade cities, in these top tier cities, the tier 1 cities and the metro cities has easily gone double in the last 20 years of cycle, right? I mean, I'm not even talking about COVID. Pick up any asset, pick up your house for that matter, that you would have acquired maybe 20 years back. The money has multiplied 4 to 5 times. I don't think any economy in the world has the kind of capital appreciation that we do in India. Reason being very clear. We have a very, very strong dominant population backing this capital appreciation. We are 140 million people, and most of them right now in the tier 2, tier 3 cities and probably villages and smaller towns who are moving to these larger cities. I'm right now not talking about the tier 2, tier 3 cities and the villages. I'm talking about the A grade metro cities and the tier 1 cities. When the influx of population will be there, when there are so many people moving to these cities, when the urbanization from 1/3 is moving to almost 2/3, we are in that journey right now. The money has to multiply the kind of capital appreciation that people have, and that's immense. And the only asset which keeps you secure, which keeps you safe in the so-called rainy days, that's as per my opinion.
All right. I have a little bit of difference of opinion here. To me, 3 to 4 times over a period of time does not matter. What is the CAGR of your investment? Considering my own experience of developing more than 250 to 300 retirement plans, whenever my clients had a real estate portfolio, I have evaluated, including the rental yield, what is the CAGR from the date of their investment to the present date. And we have done a considerable research on market rates, present market rates, considering those addresses. In most cases I have seen, it has returned less than 8% CAGR. So, in my opinion, buying a residential house or having a portfolio of residential houses or land, in most cases have not given the required returns. In some cases, there are exceptions. For example, to my surprise, a studio apartment, somebody has bought a studio apartment in Gurgaon. It has returned 17%. But those are exceptions and outliers based on the 300 people whom I have seen. And I've also seen that my clients' net worth CAGR has come down because of their real estate portfolio. But the real estate portfolio, you can make more CAGR than 8% because now there are some AIFs, alternate investment funds, which has come in, which is targeted on acquisition of data centers. So they acquire data centers, they enter into a long-term agreement, 15 or 20 years with MNCs, they generate rental yield, and after 5 years, they actually sell those because they have established a cash flow stream with which they can get a better valuation, and they sell it and distribute it among the members of the AIF, and is expected to generate about 20%. That is mathematics. Similarly, there are some AIFs which are targeted at commercial properties, office properties, which is again rented out to MNCs. So they are better looked after, and rent is not a problem. There will be no default. So they also make the same. And after 5 years, they go for newer properties and they rotate the AIFs. That is one way of making money in a more organized method, and it is SEBI-regulated as well. AIFs are SEBI-regulated. The second, how I have seen, I was also in the real estate when I was in the corporate job. I had managed a real estate company myself. So I have seen people making money who can put a larger amount of money at the stage of when or before the land is purchased, or when the land is purchased. For a big project, the approval itself costs about 3 to 4 crores, and it can take up to between 1 and 2 years. For that period, nobody is willing to finance the real estate company. So what they do is, in those 2 years, they have to raise money because every real estate company is having shortage of money, huge shortage of money. So they actually tell the investors, now invest, I will give you at 2,000 rupees per square feet, for example. So they actually reserve prime spots in the whole real estate projects at rupees 2,000 per square feet. As soon as they get the approval, which may be between 1 and 2 years in a well-managed company, it actually doubles. At each floor construction, there is a major appreciation. At the end, when the project is over, there's a huge appreciation. 2,000 becomes 10,000, which may be in the period of 5 to 7 years. This is a very good way of making money, but you have to be very careful in the selection of the builders. For example, the builder fails. You have no means of recovery. The builder can go and say, I will file a bankruptcy, but your money is stuck. So you have to choose the management, whether the builder is well managed, whether he has got a good project profiles, and select it. I should say, I should not, I don't know whether I can say this in camera. You should also have some kind of a muscle power to force the builder to give your money back in case something gets stuck. That is my own real, that's how I have seen people making a huge amount of money in real estate. So invest when the builder needs most, sell when it is very high. And some of the people who have invested at 2,000 per square feet, to my surprise, hold it till today because they are waiting for so much of appreciation, as well as they are also interested in rental yield, because most of these are commercial buildings, so let out to MNCs. So they are also interested in getting the monthly income. So they hold it also, those who can hold it. But these are all people who hold a lot of money. For them, a loss of 10 crores, 15 crores means nothing.
Okay, Lakshmi ji, I kind of, I've heard both of you. I have maybe a view which is in the middle. But somehow I disagree with you on one aspect, because maybe I disagree with both of you on that aspect. Real estate is not about investments. Commercial real estate might be, but when it comes to overall real estate, it is not about investments. It is about life operating system. You cannot operate in this world, in this life, without real estate. And finally, real estate turns out to be an investment. But let me give you 5 aspects of real estate, why it is a life operating system. Number 1 is, it is the only asset that is in your control. It is real. You buy it, you see it, you have control over it, you can modify it, you can buy a plot, you can create a villa on it, you can buy an apartment, you can do your interior decoration. There is also an emotion attached with it, and everybody who is there and is talking about financial freedom wants to have a house which is your own. So it is about control. Number two, real estate is about duration. And our human life is also about duration. We all will live for 60 years, 70 years, 80 years, and the lifespan is increasing, longevity is increasing. Real estate is the only asset that matches your duration. You can do a lot of stuff with it. It is a long term asset, and I always say, because real estate is liquid, it is a blessing in disguise, because you can't flip it. What happens is it stays with you for a longer period of time, and that is why the capital value increases. And I repeat, and I want this to be understood, real estate is long term. If equity is long term, I think equity long term is 10 years. If real estate is long term, real estate long term is 30 years. And over 30 years, let's see what real estate has given you. Obviously, your asset allocation has to be such that you are not over leveraging on real estate and then you start blaming real estate. You have to invest based on your asset allocation. What will go in real estate, what will not go in real estate. Now, last 1 year, gold has doubled. Now, how many so-called analysts or investors invested in gold? Because the prices of gold and silver have doubled or maybe more than that. So it is all about asset allocation. So first, real estate gives you control. It is about duration, and real estate is a collateral. Tomorrow, if you need, today you are talking about gold loan, but the first and foremost collateral that you have tomorrow, if you need loan, even for a businessman, is loan against property. So it works as a collateral and you don't have to sell it. Number three, real estate is about multiple utility. It can be your home, it can be your office, you can rent it, you can sell it, you can keep it as a safe haven, as you rightly said. Tomorrow, if there is a catastrophe, you need home, you are not looking, or you need shelter, you are not looking for ROI. And I'm not saying it is not just about shelter, but we have to look at it from multiple dimensions. And last but not the least, real estate is about behavioral discipline. So your EMI is a way of saving. And who is saying you have to buy 4 residential apartments? Who is saying you have to buy everything in real estate? Who is saying you have to, and let us not talk about AIFs and compare it with real estate. AIF is a financial product. REIT is a financial product. Fractional ownership is a financial product. It is a financial product disguised in real estate. I don't think that is real estate, because real estate is physical investment. Real estate is not about investments. It is about a life operating system. Real estate is returns versus resilience. If you want returns, and that is your only objective, be my guest, go into equity, go into mutual fund, go into government securities, etc., etc., etc. I have advised a lot of people on that, and all the banks, all the wealth management firms mostly only advise on these financial products. And we will see. Right now, most of the banks were saying that crypto is very risky. Now in the US, they have started advising on crypto also. So these are changing narratives. But if you want to talk about resilience, if you want to talk about an asset class that is going to stay with you, which can give you multiple utilities and not just ROI just being one part of it, then real estate has a role to play.
Okay, I would like to differ a little bit on his various exposition. I'm not talking about residential house that you own. I'm only talking about real estate as an investment. See, every company or every individual objective is to grow his wealth at a greater rate. So CAGR is everything for us. So if you want to grow your wealth, where does real estate plays a role is what I think is under discussion. I always exclude residence, because residence, we don't include it in the net worth of the individual itself for any planning purposes, because it obviously has sentimental purposes. There I cannot say, see, your CAGR is less, sell your residential house. That's not a very good argument to make with the clients. But as far as, apart from your residence house, real estate is an asset class. It is also an investment product, more like equities, mutual funds, and other things. Now, through which medium, if I invest, I can calculate a probable return. And it is regulated by law and entities. He was speaking about RERA. Recently, a company has RERA registered, has duped about 2,000 investors of more than 4,000 crores in Chennai. It has become a big news. It is RERA certified, but it has built on a land which does not belong to them. RERA certified. So RERA is not as strictly evaluating as it should. In Bangalore itself, I can see a lot of RERA certified projects failing its investors. I mean, those who have invested for their home, only home, those who have taken huge programs. So RERA is a good thing. It is better than when we had started real estate without RERA. It has brought in some discipline, but has it brought in a door to endless frauds? No. There are a lot of RERA projects which has become bankrupt, taking the money of the people who have invested their loan money as well as hard invested money. Residential building, residential house. Okay, let us take a lot of industrialists. They have not bought their own their own residential house until they are about to retire. They all have 5,000, 10,000 crores. They can buy 50 to 100 crores worth of the residence itself, and they have bought it at the fag end of their career. But what, as financial planners, we discourage is taking loan for the construction of your residence. So what we advise, a person coming at 30, see, he destroys his wealth by EMI. And today, you do not know when you will lose your job. Your job is as long as your identity card works at the gate. They don't even have no more have the courtesy to say you are fired. If you're not able to log into your work computer, you are finished, you are terminated. So with that and EMI hanging over, there's a lot of stress in these times of uncertainty. So what we guide the professionals is to invest in investments which can grow their wealth. Once their wealth is grown, they can do whatever they want with it and purchase the house on cash downright. And there are a lot of studies to back, because we financial planners do not do anything without mathematics behind it, without research behind it. So we are not against owning residential house, one or two, but it should not be loan funded. Recently, about last week, I have actually evaluated a client who is in Australia. He is Australian-based citizen. He is Indian, but taken Australian citizenship. What he has done, he is about 40 now. He did not have anything until 40 because he was having a lot of loans. What he has done is, in Australia, he has taken loans from the bank, 4 properties, and then he has invested in the house. So we have evaluated each one of his houses, present market value, when did he do it, and what is the interest he is paying. The net yield is minus. So his wealth is growing at a negative return, which means his wealth is decreasing every year he pays. And also, he has taken 45 years loan. He is retiring in 10 years. He wants to retire in 10 years. So, how will he pay the loan after his retirement is a question. So, we actually said, okay, residential house, keep it. We don't want to touch it. The rest of the house, you actually sell it and invest in Australian securities. We have researched Australian security market, and we have given him, at this rate your house will grow. It is correct. He says over a period of 30 years, we have to evaluate real estate. But what about a person retiring at 20 years? What he will do with the real estate component of his portfolio? In fact, I have advised a lot of people between 40 and 60 who come with a question whether I can retire now. And I see a lot of their money is blocked in real estate, which really does not have much return. Rental yield is very, very small, right? Yesterday, I was talking to one of my HNI clients in Bangalore. For a 60 crore house, somebody has offered him 3 lakhs rent. That is 36 lakhs per annum. This thing is 60 crores. The value of this thing is 60 crores. I'm not generalizing this, but generally, as far as our research goes, the rental yield is very small. There can be some exceptions to anything, but they are outliers. We are not speaking about it. So 30 to 40 years, yes, we have to evaluate. But what about a person retiring before? He has to have liquidity, right? He cannot live with the rental income alone because that gives very less. So
I think Lakshmi ji, I completely disagree with you. There is a complete conflict of interest because you are a personal finance professional. And say, for example, Sahil is a real estate finance professional. He is supporting real estate. You are not supporting real estate. No. And let me tell you, you're talking about two segments. At one breath, you start talking about millionaires who buy real estate at the fag end of the career. On the other end, you start talking about
That's the residents.
No, wait.
Only residents.
No, wait. You are conflicting across when you're speaking. At one end, you said, even if residential, you are saying a millionaire or 5,000 crore, 100 crore, 200 crore, they are all millionaire. They only invest in residential after, in the fag end of the career. On the other hand, you are giving an example of somebody who is a fool sitting in Australia and invested everything in real estate. First of all, we are not saying you have to invest everything in real estate. Let me give you that in India, there are $1 million millionaires by Harun list. In India, today there are $1 million millionaires. Out of $1 million millionaires, that means 9,86,000 around dollar millionaires are there in India. 60% of their wealth is in real estate plus gold. Now, are we saying all those dollar millionaires, when you start talking about them and you constitute them as dollar millionaire, if they did not have real estate, they would not be part of that list only where you're talking about ultra HNI. And mark my words, I've been in real estate for the last 15 years. The amount real estate investments after COVID have gone double and triple in the last 3-4 years. And in the last 3-4 years, equity has given zero return. Even SIPs have given negative return. So if I have a conflict of interest and if I start looking at windows, now you will say, no, equities, we should look at 7 to 10 years. I am also saying real estate, you should look at 10 to 20 years, 30 years. So I think we have to have a balanced view on this particular perspective and also be very clear what is the target segment we are trying to address.
So I'll give you my personal example. I told you I bought my first asset in 2010. Right, that was a residential asset, and then I upgraded onto a certain asset class, again a residential for my personal use in 2019. Today, me and my wife, sometimes we joke that if we hadn't acquired this upgraded residential asset that we are staying in, we would be paying a rental of around 4 lakh rupees a month to live in an asset like this. And trust me, you would not believe the EMI that I'm paying on the mortgage that I've taken for that property, on which the rental today would have been 4 lakh rupees. My EMI is 1,89,000 rupees. That's it. Trust me, my EMI that I'm paying today is half of what the perceived rental would have been of a similar property that I would have stayed in. Second, the rental calculation that we do in India, I think that's very skewed. I'll give you a live example of an asset. This is an asset called DLF Crest on the Golf Course Road in Gurgaon. It was sold at a price of 19,000 rupees a square feet back in 2019. Today we are sitting in 2026. That asset is trading at 62,000 rupees a square feet. The asset was sold at 16,000 rupees. It has appreciated to 62,000 rupees per square feet today. And the rental on that 4,000 square feet asset is 4.5 lakh rupees a month. Imagine. Now, if I calculate at a 6 crore rupee asset, I'm getting a 4.5 lakh rupee residential rental. Trust me, that is better than any commercial asset that you can recommend me even in Bangalore. See, real estate investment is about a sense of security that you get in India. We don't have any other social security that the government provides us. Education is something that we pay on our own. Medical is something that we pay on our own, right? I mean, our infrastructure is something that goes out of our heavy taxes that we pay, 35% almost. I think the only thing which gives me a sense of security in this country is that I own this asset that I am staying in. And a strong, I would say, disagreement, because I've seen those families. I have seen real estate asset literally save people from the biggest of downfalls that they would have seen in their lives. There is an area in Delhi, like South Delhi, uh, the most poshest of locality. I mean, a land would trade at around 9 lakhs to 12 lakh rupees a square yard. People own houses between a 250 square yards to 500 square yards over there, independent houses, because that was the trend, right? The colony was made, the land was acquired. Now there are families who have lost businesses, who have lost money in stocks, equity, businesses, everything. The only thing that they have as a saving grace is that their real estate that they acquired 20, 25, 30 years back has multiplied so much that all the losses put together combined have still managed, that the real estate asset has managed to give them a better lifestyle.
My one more point,
Yeah.
Sahil, here is that when people talk about mutual funds and direct equities, they conveniently talk about mutual fund and direct equities. And they conveniently stop talking about derivative trading. And then they start saying, no, 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 we are talking about long-term investment. We are not talking about derivative trading. Similarly, when you're talking about real estate, that also you talk with a long-term investment and a balanced view.
Correct.
You want to be balanced when it comes to mutual fund and direct equities. You don't want to talk about derivative trading there. That is why the government again increased the transaction tax on derivative trading. But when it comes to real estate, you say it is illiquid, you are blocking it, your EMI is there, residential is only one, and after that you don't need real estate. The point is, in India there is no social security. If you have investment and there is an emergency, and if tomorrow I have cancer, I might end up paying 2 crores. At least if there is a home, my family is safe, and if they have one more property, they can sell that property.
Correct.
It is not misused, and then use that money as an emergency fund. Secondly, not everybody has a long-term perspective on mutual fund investment and direct equity, because the moment they say returns
Not even the right
on
knowledge for that matter.
No, and see, everybody doesn't have that perspective or maturity, and especially the younger generation. The moment they see 10 lakhs becoming 12 lakhs, they want to exit, book that 2 lakh profit, and go for a holiday. But if you had a real estate, it is not easy to sell.
Correct.
That's my point.
Correct.
And I'm not saying put everything in real estate. So that is my point. I don't know, when we debate about real estate versus mutual fund and direct equity, it's a great conversation for the audience. You have to understand, everything is not in real estate, number one. And we are not saying only residential real estate or non-residential real estate. Let's simplify the whole conversation. Third, it is about your profile and your asset allocation. Now, somebody, real estate might not suit because he's at 50 and he wants financial freedom. But for somebody, real estate might suit, is my point.
See, we have recently seen somebody like Ajit Jain, who's one of the senior most executive at the Berkshire Hathaway. He's recently bought an asset in Gurgaon worth 85 crores. That's roughly, I'll be honest, $8 million. Probably a little more than that, $9 million. $9 million for a home that probably he will use maybe for 30 days in a year, right? Sitting in the US, not as a resident of this country, but he knows that he's a frequent traveler to the country, probably 30 days. Let me buy this asset, because this asset, the way these assets have multiplied in the last 10 years, 20 years, he knows that this 85 crores definitely will become probably 300 crores in the next 15, 20 years.
All right. I think emotions are running high here. At the start of this discussion, I have clearly defined how we advise our clients. HNIs, yes, we recommend real estate as a percentage of their assets. Less than HNIs, no exposure to real estate, and the residential building is to be bought on saved money, saved wealth, I would say, not money. UHNIs, yes, I have clearly told with an example how UHNIs make money in real estates. Those who can invest 15, 20 crores at the start of the project. So within a short period of 5 years, they make a greater returns. So nobody is comparing less than HNI or UHNI. The more UHNI you are, your percentage of asset allocation can be greater in real estate as well, because your ability to bear the risk in case of a loss is very high if you are having as your corpus grows. But if your HNI are below, a certain percentage of allocation can be made to real estate. And how to make that money? The residential house is excluded from our argument at all cases. Okay, let us forget about residential houses because emotions are attached to it. So how to make money in real estate through structured products and the unstructured products, I mean projects which are not so structured, is what I'm talking about, right? How to bring certainty to the return on investment on real estate is what, as a financial planner, I'm talking about. That's all I want to say. I'm not against real estate as an investment class. I'm very clear that investment class. Second thing, evaluate your real estate portfolio as your other assets. See how your other asset classes have grown. See how your own portfolio has grown. If your portfolio has grown 17%, we have asked our clients to retain the real estate. There's no need for me to ask them to dispose of, because I have no, I'm not biased towards real estate, or I'm not for or against. I am against how much CAGR it is making, whether your other assets are growing faster than this. If there's a great gap, then leave aside the emotion attached to the real estate, except your residential house, and evaluate it as any other asset class, and make your net worth grow at a higher rate. If the real estate asset class is pulling your net worth, which consists of your gold, silver, any other asset that you have, if that is pulling you down, then you dispose of the asset that is pulling your this thing down and invest in assets which can make it grow. So let sentiments not be attached. Secondly, he was telling about houses being used for emergency fund. Houses cannot be used for emergency fund. It's not easy to sell. Tomorrow, day after tomorrow, I need money. You cannot sell your house within 3 days and get the emergency fund. So emergency fund, we are very clear, it cannot be parked in real estate.
Let me talk about emergency. I was 19 years old. My father is a legendary army officer. If my father did not have the home in which we were staying, I don't think I would have been able to do my MBA also.
Of course.
I don't want to get into details, but if it is not an emergency, real estate is emergency for regular income also. Okay. I don't know what my mother would have done if she was not getting rent from the top floor. And obviously, she also had my father's pension. But if that extra rent was not coming in, she would not have been able to educate me.
Absolutely.
So real estate, I repeat, is emergency because it is a product which is scarce. It is a product which is a necessity, not just your residential home, as an extra home also. And it is a product which is in your control, and because it is illiquid, it has a lot of strength attached to that asset, because you don't easily flip it and the value keeps on growing over a period of time. You might take 1 month, 2 months, 3 months, but when you are able to liquidate it, the amount that comes to you is in a handsome chunk.
Absolutely. I'll give you a personal example. I'm probably the youngest person over here. I'm 40, and I can speak on behalf of somebody who's 35 to 45, the circle that I kind of sit across with. I'll be honest, sir, we are not emotional about our real estate assets anymore. In the last 20 years of my stay in the Delhi NCR region, because I don't belong there, I've upgraded into a third house. And I'll be honest, the next opportunity that I get, I'll upgrade into a fourth house also. So the average cycle, my father, when I was born, he stayed in one house, and till date, I'm 40, he's still in the same house. It's been 45 years, he is in the same asset class, and even till today, if I tell him to kind of move out, sell that property, he's emotional about it. We are not. We are not emotional about the assets that we own. For us, real estate is purely any asset, like maybe an equity, right? Maybe a stock, maybe gold. if I get a better opportunity to trade it off at a better price, increase my wealth, move into a better asset, why not? And I'll be honest, most of the people, our generation, are into that mindset. We are not emotional about it.
But
And
I'll
exactly
tell
like
you,
US and Canada.
Sahil, what Lakshmi ji is saying, there is a very broad Gen Z population
Yeah.
which has a similar view like him. And you might not be emotional. I would go another, because the current new generation is not emotional. There are a lot of people who carry the same view as Lakshmi ji, who don't want to invest in real estate because it is a high capital investment.
Correct.
Maybe one, they do not have that much of money, because real estate investment now has become expensive. Everybody can't afford real estate. The new generation who's just starting a job, a minimum home, फॉरगेट एनसीआर में तो खरीद ही नहीं सकते. बैंगलोर में भी a minimum 3 bedroom is 2 crore. Somebody who's starting his career with 10 lakhs, 12 lakhs, 15 lakh, 20 lakh, unless and until they over leverage themselves, they cannot buy a real estate.
Sir, but I'll be
So
honest.
on that front, if that segment is there, real estate is becoming unaffordable.
Correct.
The examples of Gurgaon that you're saying, 50, 62,000 rupees square feet, a new generation guy or a person who's starting his job for the next 10 to 15 years also cannot buy a crest.
Absolutely.
So, I will again come back. The Gen Z is not too much in favor of real estate, like Lakshmi ji is saying. Why? I'll tell you, because there is an angst. They have an angst that it has become unaffordable, and that is why they hate real estate. Because the moment they would be able to afford real estate, they will not hate it. But today they know for the next 10 years also they cannot buy real estate, so they want to be against real estate. And that is why equity, mutual fund, gold, silver, crypto gives them that kind of a return, and they are moving there. So, it's very, very important in a conversation like this that we are very clear what is the target segment we are addressing. For example, I can afford a much bigger house, but I stay in a 3 bedroom apartment in Bangalore. Many people say you should stay in a villa, you should stay there. But I am a conservative guy. I've been staying in that home, 2,500 square feet. People who rub shoulders with me, everybody stays in double the size of home and mostly in villas. But I don't do that because I don't want to leverage. And I am very fine with what I'm staying, and I don't want to define my status with the real estate which I'm staying, because I want my status to be known by the knowledge I have, by who I am, by what I contribute to the society, what is my position in the sector, etc., etc. So you are also right. He is also right. Maybe I am also right. The point is, what is the target segment that you are trying to do? But the real answer is you cannot get lopsided. Finally, you need real estate and you need other assets. But the challenge in today's real estate is that land has become very expensive. Real estate has become very, very expensive. And everybody cannot afford real estate in the top 7 cities. And maybe that is why tier 2 cities are growing. Tier 3 cities are also growing, because affordability is still there. The problem with real estate today is in the top 7 cities, and Gurgaon leading it, Mumbai following it soon, is unaffordability.
If a 25-year-old has 25 lakhs, where should they invest first, equity or real estate? See, according to personal financial planning, first he should sort out his insurance, term insurance, which would give a substantial amount of money should he die, medical insurance, and personal accident insurance. Then he should, out of this 25 lakhs, he should create a contingency fund, which is easily accessible and which gives a little more than FD interest in instruments which is not related to market. The rest of the things he can go for the wealth creation. I would recommend, as a financial planner, equity and equity mutual funds. So there has to be a proper allocation considering his goals in life. So in personal planning, what we do is we capture his life goals, in which year he wants to achieve that, what is the inflation adjusted cost of that goal, and then we go about advising about asset allocation. But since the question is about a 25-year-old having 25 lakhs, sort your insurance first. Create contingency fund, which is 12 months, in today's world, 12 months salary. Then you go about creation of, you invest in wealth creating instruments.
See, if 25-year-old had rupees 25 lakhs, where should he invest first? Equity or real estate? Now, the point is that if at 25 years he has 25 lakhs, what is he doing? Is he salaried? Does he have a business? Is this inherited wealth? Because I did not have 25 lakhs when I was 25 years old. Number one. However, there is a possibility. The second point is he staying in a tier 2 city or a metro? Now, if he's staying in a tier 2 city, and I'm assuming if he has 25 lakhs, he has a good income stream. In tier 2 city, he can get a good 2 to 3 bedroom apartment for, say, anywhere between 75 lakhs to 1 crore. And I'm assuming he has a salary of 2 to 3 lakhs because he has 25 lakhs of corpus at 25. So, what it means is that from his salary, he can look at his debt service ratio. Generally, the fundamental is that 50% of your salary should be for your personal expenses, and maximum payout on EMIs, which includes your personal loan, credit card, and mortgage EMI, should be not more than 50% of your take home. So he can easily pay a lakh kind of a EMI if he has an income of 2 to 3 lakhs, can do a down payment of 10 lakhs for a 1 crore apartment, and the balance he can invest in insurance, in mutual fund, and do an asset allocation. If he's in a tier 2 city, he can buy a property. However, if he's in a tier 1 city, he's in a Delhi, NCR, Mumbai, Pune, Bangalore, Hyderabad, Chennai. You see, you have to peel the onion. I don't think he would be or she would be able to buy real estate with 25 lakhs, even if he has, because there is an affordability issue. Still, there are properties which he can still find at the outskirts, which are between 1 to 1.5 crore. It is always good to have your first home because that is not real estate investment, that is security, that is stability. And if within 50% of his disposable income, he is able to service the EMI, if he is married and if his wife is also working, the household income can also be, seen. However, he can still afford an EMI of 1 lakh rupees, which is say a 1 crore benchmark loan. And if he puts 10 to 15 lakhs there in the outskirts, he can buy it provided he wants to stay in that house and not as an investment. As an investment, I would not suggest to put that money in real estate. Otherwise, invest in equity, invest in mutual fund, invest in insurance based on his risk profile and long-term objectives.
Now, this question seems very personal to me because I think when I was 25, I had the opportunity of having something very close to 25 lakh rupees. And I'll tell you exactly what I did. First of all, 25 lakhs is not enough money to own an asset in any of the top 7, 8 cities in the country. Not even when I was 25, which is almost 15 years back. If you have 25 lakh rupees, which is 20% of the total asset cost, you definitely have enough and more money to pay the down payment of that asset. But the second thing is the affordability of the EMI that you're going to be, the asset that you're going to be buying. So if you have 20%, which is 25 lakh, you can afford an asset of 1.25 crores. That means you should be able to afford an EMI of roughly 80 to 90,000 rupees a month. If that is a possibility, you have a running income of 2.5, 3 lakh rupees, or maybe a joint income between you and the family, then yes, definitely you can buy an asset worth 1.25 crores, 1.3 crores easily. I will definitely also talk about things which are strongly not advised and not to do with 25 lakh rupees. Now, this is an opportunity which a lot of developers in the NCR market where I belong to, they realize that this is a big opportunity. There are a lot of people between the 25 to 30 who collect 25 lakh rupees because of the bonuses that they receive, because of the incentives that they receive, and they don't know what to do. So the concept of virtual spaces came in. I'll be honest, this is where people lost most of their money. The money got stuck because virtual spaces, this is not real estate. I would not call it a scam, But this is not a physical asset that you should ever own because it's difficult or impossible to exit a virtual space. There is an assurance of so-called assured rentals, but assured rentals are being paid from your money itself. So never try and buy property which sounds too good to be true. Right now, currently, as we speak, there are markets which are promoting assets in between 25, 30, 40 lakhs in the state of Gujarat. I don't even recommend that too. There are assets which are being promoted in the state of Maharashtra in the name of Goa. I don't even promote that. So if you have 25 lakh rupees and you're trying to mandatorily invest in real estate, it doesn't matter where is it in the country, don't do that unless and until you can see it within your own eyes and you understand the asset and the location and the geography pretty well, and most importantly the developer's profile. So if you can afford an extended EMI of 80, 90,000 along with this 25 lakhs of down payment that you have, then definitely go for an asset of 1.25 crores. Otherwise, I'll be honest, invest money in equities, invest money in mutual fund, invest money in stocks, but not in real estate. And being a realtor, I'm saying this.
What are some of the common scams in real estate you have personally experienced? Most of the scams are around title ownership. Somebody just said, I think Lakshmi sir was saying that there was a client, he bought a property, it was for some reason he's saying it was RERA approved also, and after that they found that there was a title issue with the land. So that is one area. Number two is the same property being sold multiple times. This is one of the scams which is there. So it is very important for you to understand who are the people, who is your channel partner, who is your developer, who is helping you, from whom you're buying, who is facilitating you. Because in real estate, the role of channel partner is very important, because real estate is B to B to C. Most of the properties are bought through channel partners, and there are very good channel partners also. And you have to choose the right channel partner so that they don't advise you wrong. And then you have to do your own research. The internet is a great tool. People are a great tool. So please ensure that one of the scams is that the same property is sold multiple times to people. There can be payment frauds. You end up making payment to the wrong people. Sometimes what happens, you end up making payment to an intermediary and not to the direct developer, or you have not verified that. That can be one of the frauds. And last but not the least, what I have learned, and this is something, there can be a promise fraud. Now, what is a promise fraud? You're buying a property and they say there are so-called these amenities, these facilities will be there. You go and see a mock-up and you find that, okay, this is what it is. You see a brochure. I'm myself from real estate. With RERA coming in, this has also been curtailed, but it can be one of the issues where what is being shown to you and what is being promised to you and what you get, there is a big difference in it. So these are four things that you can take care of. And as I said, the market is evolving. Today we are at 450 to 500 million dollars of real estate industry. The industry is going to double by 2030 to $1 trillion. We are moving into a space where the world is looking at us, and hopefully these issues should not happen in the top markets, but we have to be careful, especially in tier 2 markets, because maybe the implementation and the governance might be weaker there. I'm not making any statement, but it is always important to be careful, because real estate investment is a big major investment, and it is the lifelong saving of a person that gets into it.
See, when we talk about scams in real estate, I think most of the scams in real estate happened in the early 2000s. Some of them have been curtailed drastically with RERA becoming more and more stronger in most of the states. The current scams which we see happening is sometimes you have an opportunity which is too good to be true. I don't think we as investors, home buyers, should fall for such opportunities without 100% due diligence. The biggest, I think, asset that we have today, the biggest advantage that we have today in the business of real estate is we have A grade listed developers already present. There are properties which are sold as virtual spaces. try and avoid that as much as you can, because very, very difficult to exit. You've already extracted as much return as possible in the next 2 3 years duration. At the time of exit, no end user or no new investor would want to enter into an asset which has already gotten its maximum premium and has no physicality to it, because I can't touch it, I can't feel it. In a large floor plate of, let's say, 20,000 square feet, I own, let's say, 100 square feet. I mean, I'm nowhere to be found even on the map. So avoid such places at all.
In my experience, I've come across the same commercial space being sold twice or thrice, especially if you are in the fractional ownership of a big commercial building. You do not know which area belongs to you. It's a fractional ownership. So the same prime space is being sold twice or thrice. It's a very common practice that I have witnessed. Second thing, see, even though RERA has brought in a lot of discipline, a lot of redressal mechanism for consumers, for people who have paid the money, I have seen that a lot of developers, due to the bad management of finance, is not able to complete the project, nor able to pay the consumer. So they file a bankruptcy, in which case, in spite of RERA being there, the consumer loses money, the customer loses the money. The third aspect is, I've heard only one instance, and that is very public. In Chennai, there's a company which has cheated about 2,000 people of, I think, about 2,060 crores by building an apartment in a land which is not their own.
And it is RERA certified.
It is RERA certified. Second, check the reputation of the builders. I've seen in real estate, in spite of the developer being very honest, he has no intention to cheat the public. He could not repay to his customers because he is bad in financial management, which many real estate firms are guilty of, because they over leverage and they are not able to complete or return back. That is so scam does happen even with good intentioned developers because of bad management practices. That's what I have seen.
Actually, I would just want to say that real estate development is a complicated business. It has multiple things involved, and we have been saying the same thing. But for any developer, for the benefit of the audience, for the benefit of people, there are three very important things that a developer needs to do today. And I'm talking both as a developer, as a consultant, as a banker. Number one is financial discipline is very important. We've been speaking about it. The other thing is the overall governance is very important. Because in real estate, reputation is the real currency, because it's a long-term business. You're, somebody who is building a career in real estate as a developer also. All the good developers today are 50 years old, 60 years old, 70 years old. They have been here for some time. So reputation is the real currency. And the third aspect is a good developer, a good channel partner is also bringing in a lot of technology in the way they do business. And technology has become a part of a capital stack. Whether you call it fintech, you call it prop tech, with the advent of AI, lot of technology is being bringing in. So these three aspects any developer should look at. And as Lakshmi ji, you said, get a good lawyer. The replacement of a good lawyer can also, it might not be a replacement. That is why I said, and that is what people like Sahil bring to the table. Your real estate consultant, broker, channel partner, advisor, wealth manager, whatever you want to say, you are going through somebody. That selection is also very important. We keep on saying that the developer selection is very important, but we forget that in real estate, you go through somebody most of the time. You have an intermediary. Now, in financial services, like you are an intermediary, but you have passed your SEBI, you have passed your RBI, you have passed your IRDA. You are so well regulated in the Indian financial services system that, because I was also a wealth manager with Citibank in 2002, we had to pass exams, we are regulated, and India is one of the most well-regulated markets when it comes to financial services. That is why I will easily suggest somebody to go to you and take advice, because you are certified. And in real estate, Now that the RERA certification has also come, people should be aware that who your channel partner is, who your broker is, because most of that challenge will get simplified if you're going to the right channel partner. Like, I am an advisor to NAR India, and Sahil is also a member of NAR and leads NAR, works very closely in the Delhi NCR chapter. Now, NAR is a channel partner real estate professional body which is focusing a lot on training, a lot on certification. I am also a trainer with NAR. I go and train channel partners. And so if there is somebody who's part of NAR, somebody who's part of, say, an international company like what Sahil is, all these things become good checkpoints so that your advisor is the right person. Like in mutual fund and financial services, finally, the customer does not know which mutual fund is right. You are doing your research.
Correct.
And then you say, okay, why don't you invest in ICICI or HDFC or Axis or so and so mutual fund? Similar is the case with real estate, and this is one similarity which is there between both personal finance and real estate. So we should be very, very careful who our advisor is.
Buying under construction property and flipping it after 3 years, what's your opinion on it? I think there's a hidden answer in the question itself, wherein you have mentioned a period of 3 years. Now, 3 years is that sustainable time frame which is the right time to flip a property. Now, the problem has arisen, problem has started, wherein people started thinking that I might be able to trade off real estate in 6 months. I might be able to trade off real estate in 1 year, right? Quick money. There is no quick money in real estate. Real estate is a long-term, stable, sustainable game, wherein anything below 3 years is literally a pure luck or somebody's trying to scam you. I'll be honest. 3 years is a very reasonable time. I'll give a classic case of one of the projects that we sold in 2023. Since we are sitting in 2026, it's exactly 3 years now. It's a project by DLF called The Arbor on the Golf Course Extension Road in Gurgaon. Now, Golf Course Extension Road is the second best micro market of Gurgaon. The project was sold at 17,500 rupees a square feet. Today, in the resale market, the product is trading between 26 to 30,000 rupees a square feet, depending upon where your unit is located. Does it face the greens or the pool or the preference of the floor? Now, people have paid roughly 50-55% of their payment as per the construction link plan that DLF has. And there is a premium of almost 3 crore rupees, and it goes up to 5.5 crore rupees for a good unit and a not so great unit on every single unit of the project. And mind you, it's a large project. It's a 30-acre of project with almost 1,100 apartments. And today, every apartment is giving you a premium of close to around 3 odd crore rupees. Mind you, people have paid roughly 3.5-4 crore rupees to the developer, and this is the same amount of premium plus minus is what they're getting, and some of the good units are even getting more than what people have paid for. 3 years is a reasonable time. Again, caution, not every project will be like DLF Arbor because it was sold at the right price. The developer intentionally left some money on the table for the investors. So you have to look at the developer's psyche as well. A lot of developers like DLF, like Aditya Birla, like Adani, I have seen their strategy in the last couple of years in Gurgaon when they've seen the market sentiment is a little tight. They've literally priced their product very correctly. In fact, they have priced their product lower than a non-organized, non-listed developer next door, and they have sold it out in 24 hours and 48 hours. So the developers are very clear. They want to build long-term investors. They want to price the property right. They want to curtail down their sales process, and they don't want to have a process of sales running down for a couple of years. Rather than price it right, sell it on day one, and focus on the construction and the delivery. That's what developers are doing. So with regards to down payment and loan and mortgage, I strongly believe 20% is the bare minimum money that you should have as capital to buy any property. If a property is worth 2 crores and if you are not even having 40 lakhs liquid available with yourself and probably some more available in the bank for your day-to-day emergencies and exigencies, then you should not go ahead and buy any real estate. 20% is the minimum wealth that you need to possess as a down payment, plus some more money in the bank liquid. I don't think buying an asset which kind of sits on your head as a dagger is a great decision. You should be comfortable, right, investing that 20% down payment and still have another 10-15% back in the bank, which is purely liquid, and then invest into real estate. I think all the good assets, especially when we talk about residential asset class, 75-80% mortgage, all the banks they would easily be able to do. And mortgage is always good. You cross verify property from the bank itself whether the property is legitimate or not. If the property is financed, even I feel if you have the money, if you have the entire down payment available with yourself, then also try and avail some mortgage on that asset, because you cross verify the documents more than double. A bank like SBI, I mean, they would probably want to get into the depth of the chain of the documents, and you can never do that on your own personal self. So mortgage always should be taken, because it cross verifies, legalizes, and puts another stamp of an institution like a bank to it as well.
I agree with Sahil because when I was in the real estate business, we used to tell our customers, avail a bank loan from SBI or LIC. Their lawyers are very strict and they don't go after business. So what Sahil says is absolutely I agree.
Do Indians trust real estate more than stock markets?
See, I think Indians, I don't think trust real estate more than stock market. But there is a reason why. Let me get into some data on that. You know, people find real estate illiquid. People find it opaque. People find it that it has high transaction costs. People also look at real estate from an execution risk standpoint. And many also, because real estate is an emotional decision, people feel that real estate cannot be trusted as much as stock market. But I would say after the changes that have happened, after the way real estate is growing in India, after regulations that have come in, real estate, trusting real estate is not going to be an option. You are going to buy real estate, whether it is your first home or it is your second real estate investment or your third real estate investment. You need to be careful. Unlike investing in stock market, because all the due diligence is done, you go, you open a broking account, or you start investing in mutual fund. Here, I think there is a tad bit of due diligence that is required. And if you do that due diligence, real estate is as good as a stock market, because we now have some very credible real estate players across the country which are operating, and the sales that are happening in real estate that have happened in the last 3-4 years demonstrate that the perception that people don't trust real estate is a little more, because there are people who are now investing in real estate in a big way.
UHNIs do trust real estate to be a part of their assets, but HNIs and below HNIs, they may not trust that much in favor of other financial assets because it is illiquid. At the time they want to sell, it cannot be sold, and there are no mechanisms to find out what could be the increase in the price. It differs widely between, as my friend said, between the areas and where they have invested.
See, when it comes to trusting real estate versus stock market, I think historically and even till date, the trust towards real estate is significantly higher. And I'll be honest, I would be bold enough to make a statement. There is not even a comparison. I think it is only in the last few years, with the emergence of internet, with the emergence of apps like Grow, Zerodha, that the investment into equity stock markets has grown significantly. The number of people investing into real estate versus number of people investing into stocks and shares, I mean, even if we pull that data out, I think the data would be maybe 2 or 3x, or probably even more. What I've realized is a lot of generation, especially the Gen Zs and I would say the low-age millennials, those are investing in stocks and equity market. One of the biggest reasons for them to invest in stocks and equity market today is it is so easy. It's at a click of a button, and you can invest in an IPO at as low as 15,000 rupees. You can invest in shares in stock as low as 5,000 rupees. But I'll be honest, there is a lot of knowledge, information, intelligence required to be investing in stock markets and equities. I mean, real estate, if you have the basics right, if you're investing in the right location with the right developer, and just spending some time checking the right title of the property, your basics are right and you can't go wrong with it. But with the stocks and shares and equity, most of the people are still relying on tips of their friends and families and chachas and friends and brothers, and they're not using any of their own research, due diligence, and don't even know how to do it. So the kind of illiteracy we have as far as investment in stocks and shares is concerned, I think I still generations apart. If I talk to my grandfather, if I talk to my father, if I talk to myself, I think all three generations would put their trust and faith in real estate over and above stocks and shares.
No, actually, you are right. One point is definitely there that, this becoming quick rich is what the stock market is doing, and the younger generation prefers convenience and ease of investing and affordability to getting into real estate, and that is why they are a little negative on real estate, because as I said, real estate is an issue with affordability.
Correct.
And there is no affordability challenge when it comes to investing in a stock market with these current apps and all. And there is a perception that you can become quite rich because of various things. So you're absolutely right, and you made a very good point that actually, if you look at data, there would be more people historically who would have invested in equity, in real estate, than in equity or stock market. And that is what the mutual fund industry has been playing on, that the penetration of mutual fund in India is 10x lower than developed economies like US and all. And that is why there will be more money that will come in Indian economy, because more investors will come in mutual fund, and that is why markets will go up. So invest in mutual fund. So there is a narrative in both, and that is why there is a conflict of interest which comes whether you're talking about stock market investment or you're talking about real estate investment.
See, I think it's only now that we have started talking about equities and stocks in the last 1 decade, since the time Zerodhas and Grows of the world they've come in. Unfortunately, the only downside to it is there are a lot of young investors who are using Zerodhas and Grow as the Blinkit and Zomatos. Now that's the biggest problem. You cannot use a Grow or a Zerodha because serious money is involved. You're not ordering a 200 rupee sandwich. You're making a lot of investment into a product which you have literally no knowledge of. So I think a lot of financial literacy has to be there before people start investing in equities and stocks. Of course, there are great instruments, but without the right knowledge, without the right information, it's as good as betting on a cricket match.
See, residential real estate is your home. Everybody will buy residential real estate. For data, 80% of Indian real estate is residential real estate. 20% is commercial, industrial, warehousing, retail, and hospitality. So let us get our facts together that real estate in India, 80% is residential real estate. Number two, residential real estate has a great promise in India because the first time buyer of India is very, very big. So there are three kinds of residential real estate buyers. Number one is the first time buyer. Number two is the second home buyer. And third buyer is the upgrade buyer who is living in a 2 bedroom, has a bigger family, and now wants to live in a bigger house. We have also seen a trend in residential after COVID that people wanted large homes because of work from home and all, and enough and more has been spoken about it. So residential real estate, your first home, obviously you should buy residential real estate. A lot of people invest in residential real estate as an investment also because they are familiar with residential real estate. So they are people who invest in residential real estate, and they might not buy an apartment, but they can buy a plot. Coming to commercial real estate, it is basically the savvy investor that gets into commercial real estate. Generally, HNIs and ultra HNIs who want either an alternate source of income or who want portfolio diversification within real estate, that they get into commercial real estate. Mostly it is the HNI or ultra HNI who gets into commercial real estate. And it is an important aspect of a portfolio from a real estate portfolio sense, not from an overall portfolio sense. So I would feel that still 70 to 80% of people investing in real estate, because of familiarity, because of various other things that I spoke about residential, invest in residential real estate. And it is 20-25% of savvy people, and mostly HNI and ultra HNI, who diversify and get into commercial real estate. Also, there are not many developers who are into commercial real estate, and that's why the options in commercial real estate are lesser, and the ticket sizes in commercial real estate are also higher, which are from grade A developers. Now, the moment you go to grade B, grade C developers, the ticket size of commercial real estate can go down, but then there is a risk. There is a lot more due diligence that should be done if you are going and buying from a smaller developer, whether it is shops or small offices. So there is a bigger risk in from that perspective.
See, commercial and residential real estate, they are two very different asset classes, right? And they should never be looked at as one as well. Residential real estate is a no-brainer asset class that you can invest in because it's a real demand-based asset class. I mean, you go to any of the major towns, right from Bombay to Delhi to Bangalore to Pune, you would see most of the residential real estate asset classes have takers. But when it comes to commercial real estate, right from Bombay to Bangalore to Pune to Delhi to Gurugram to Noida, a lot of commercial assets would be vacant because the commercial assets need a lot of intelligence. Like he very rightly said, that the grade A developers, they understand commercial real estate. But now there is a set of developers who have entered into commercial real estate, category B, category C, whose understanding of commercial real estate is next to negligible. They've never run commercial or retail assets, right? They don't understand the basic, I would say, the dynamics of running a retail mall or a commercial office space as well. Now, these assets sometimes they become literally counterproductive. I know a lot of investors who have invested in commercial real estate and they're getting negative returns. Why negative returns? There are heavy common area maintenance charges as high as 25, 30, 35 rupees per square feet. And they're literally paying out of pocket because the commercial assets are vacant and the developer does not have the bandwidth or the intelligence or even the know-how to lease that property. And as an individual investor, I don't know who to lease it to. I don't know who to go to, right? Whereas it's very different to an residential asset class. So a lot of homework has to be done if you have to invest in a commercial asset class, wherein I'll be honest, a residential asset class is a no-brainer. We have a population of 140 million. We are still struggling to give a home to each and every individual in this country. So two very different asset classes and should be treated very, very differently.
From the returns point of view, what my experience has been is that the commercial properties have more appreciation value. And also, the commercial properties are mostly rented out to MNC companies who actually maintain them very well. If you have a portfolio of residential properties and if you have rented it out, each time the tenant vacates, you have to spend a fortune in rebuilding the house. So, from the investment point of view, commercial properties score over residential properties in terms of value appreciation as well as good maintenance of the property as well as the rental yield, because MNCs can pay a much bigger rent than an individual who can pay a lesser rent in residential property.
No, but just a caveat here, the commercial property that an MNC will buy would not be less than 200, 300, 400 crores.
Correct.
So it depends who is the target segment we are talking about, because an MNC will buy a floor plate of not less than 50,000 square feet, 100,000 square feet. They will not buy it in smaller towns. And there the segment is more corporate, because MNC is a corporate buyer. And I think if we have to talk about individuals, I don't think there are many individuals who can afford to buy a property that can be rented to a multinational.
Actually, my experience has been a little bit different, because one of the ways of financing a commercial property project is to make it fractional ownership. So anybody with a 5, 10, 15 or 20 lakhs of rupees can buy a fractional ownership in a 500 crore commercial property minimum ticket size may be about 25 lakhs.
Yeah,
Anybody who has got
that is
25
called
lakhs,
strata sales.
so they can afford, and that gives that investment gives much more value than investing the same amount of money in a residential property.
So the only downside to that strata sales and fractional ownership is there is no physicality to the asset that you own. And there
And
is
secondly, the top grade A developers, like
don't
for
do it.
example, DLF does not do
No.
strata sales. We can take many other names.
Correct.
The top tier grade A developers who are into real estate, commercial real estate, because the biggest owner of commercial real estate in India is an American company called Blackstone.
Yeah.
So let's really understand that when it comes to commercial real estate, true commercial real estate is bought by organizations and institutions and MNCs and not by individuals. So if it is about personal finance, if it is about individual investment portfolio strategy, asset allocation, HNI, ultra HNI, there would be very few people who can afford these kind of high ticket commercial real estate projects.
Absolutely.
Just want to quickly ask you whether your views on real estate and equity mutual fund has changed after this roundtable discussion.
See, I have always looked at real estate as an asset class. As a professional, I evaluate the CAGR or XIRR, whatever is applicable, and compare it with other asset classes over the period of time, and then take a decision. So it is not a one-size-fits-all solution for everybody. As I have said, UHNIs, yes, can definitely invest a part of their portfolio in real estate. The more net worth you have, the more can be the allocation in real estate, because there are ways to make a good amount of CAGR which beats even the equity. But the risk is very high. You should be able to afford that risk. So your net worth has to be comparatively very high. But if you are into the wealth creation or even HNIs, HNIs also can allocate a smaller portion of their assets in real estates. They can also make a little bit more money. But for those who are new into wealth creation, my opinion has not changed. They should not buy real estate or their own residential property with loan. Without loan, we guide people how to realize their objective of getting a house. So we are not against a residential house for anybody. Everybody should get a residential house. But how to finance it is what financial planners differ from the ordinary people.
So I think in India, not owning real estate is the biggest risk that you will ever have. I think some of the pioneers like Nikhil Kamath, they started a discussion of real estate being not relevant and not owning a house being the status symbol of today's generation. And I think he's the one who bought the house very recently, and a pretty lavish house. So I think everybody, right from the industrialists to the startup founders to the normal general population, the common population, in the country like India, wherein the sense of security, the sense of social security is not there, the only asset which gives you safety, security to you and your family is owning a piece of real estate.
See, I'll explain it. I have been part of the wealth management industry. I worked with Citibank, Deutsche Bank. I keep on telling that I moved into real estate. First of all, the biggest scams that started in India were in the equity side of real estate, were in the insurance side of real estate, where asset allocation was not done. Wrong insurance products were sold to customers, which had very heavy loading, and those insurance products were less of term and more of investment projects. Secondly, if you're doing proper profiling, anybody at the age of more than 58 and above should not be given more than 20 to 25% equity in their portfolio. And any top end private banking firm of the world would say that, because the idea would be to take care and safeguard the capital, give regular returns, and not put assets in a highly risky asset class. And equity across any wealth management firm, any bank, any private bank across the world, not just in India, is considered a very high risk asset class. Number one. Number two, when it comes to real estate, in Indian middle class family or in the Indian society, the parents are obsessed with three things for their children. Number one is educating their child. Number two is getting the child married. And number three is making the child own his or her own home. These are the three obsessions any Indian parent has. And when an Indian parent sees that her child is educated, has been married, and owns his or her own house, they feel their responsibility is over. The answer is there for the audience to decide whether it is real estate, whether it is mutual fund or equities, or whether it is both. But it is about asset allocation, it is about right profiling, whether you are a conservative, moderate, aggressive investor, and basis that, what would you want to invest in. However, the basic need of having one home is important and it will always remain.